So perfect time to bring on board Mahesh Nathunkar, Executive Director at CLSA. He joins us on the sidelines of the CLSA India Forum. Mahesh, 150 delegates, what are the key takeaways from the delegates, and are you getting a sense that some of your global clients, after some of the recent government initiatives, have they turned positive on India?
We've had a good set of turnout at our conference. As you mentioned, a lot of investors. More than 3/4 of those are from overseas, from almost 20 odd countries. The mood at the conference is definitely much better than what it was, say, a year or so ago. And clearly one of the reasons being, how the markets in India have behaved over the last 7-8 months. Also what the government has been doing in terms of making certain announcements, making certain policy initiatives, which is clearly appreciated by the investors. Some of the investors have clearly participated in this rally and are feeling quite happy about that. Obviously some others haven't. But the more important point is that the overall mood towards India is definitely more positive. Most investors appear to be constructive. Clearly the concern at this point in time is on valuations and whether the valuations have already captured all the positive news that has hit the market so far. So that's really is the key questions at this point in time. But the mood generally is on the positive side.
So what is your view, Mahesh, in terms of valuations? Is everything in the price? In your recent report, you said that the worst is behind us.
I think the market definitely needs some more doses of policy action and improved corporate performance to move up from here. And our own sense is that both of which are likely in our view. We've already seen the corporate performance improving. Over the period of last 3 quarters or so, we have seen consistent reduction in the amount of corporate earnings downgrades that have been happening. So earlier in the year, we used to see about 3 to 4% average earnings downgrades after every result season. In June quarter, it reduced to 1.5%, which was an improvement. And this quarter so far, we've seen about 75% of the companies that we cover have already reported. And on an overall basis, we haven't seen any earnings downgrade in this result season so far, which is definitely an improvement. And from here on, we need this momentum of positive news flow to sustain for the markets to move up, which we think is likely in the near term.
So Mahesh, give us a flavor of stocks, companies, and some ideas, and which exact, what you also bullish on banks. So what do you like within the banking space?
The early cycle story that you just referred to is something that we've been talking about for some time. We think that we are in the early stages of an investment pickup. And just to repeat, investment pickup, the cycle pickup, I think is probably likely only 12 months down the line. Before the investments actually begin to pick up, what we will need to see is the banking sector lending to the infrastructure needs to improve, which has been under pressure for some time because of NPA-related worries, etc. And a lot of public sector banks are trying to cut down their exposure to that segment. So what we believe is before the capex cycle revives, the NPA worries need to reduce from the current levels, and which is what we think will probably happen over the next 12 months. And that makes us more positive on the corporate sector banks, the banks which have greater exposure to the corporate sector. So in that context, we like ICICI Bank, we like Axis Bank, we also like IDFC. And within the public sector banks, even State Bank looks to be an attractive bet.
Right, Mahesh. But what made you turn so positive on industrials?
On industrials, what made us turn positive, incrementally over the last 1 month, as I said, is we are closely watching the performance of the corporate sector. We had done a fairly detailed work on the capex cycle a couple of months ago, and we had clearly highlighted that for the capex cycle to improve, we need to see improvement in the manufacturing sector margins and manufacturing sector ROEs. And what we saw, or what we've been seeing for the last couple of quarters, is an improving earnings trend, which is actually paving the way for margin improvement and the ROE improvement down the line in a few quarters from now. Looking at the corporate sector earnings trend, we believe that the worst in terms of the corporate sector ROEs and margins is behind, and from that point of view, we are now beginning to look at manufacturing sector, capex, moving up, possibly in 12 months' time from now, and that is what has made us, cut our underweight stance on industrials.
Right. So, Mahesh, if I look at individual stocks in your model portfolio, you have recently replaced Lupin with Power Grid, and you've got Z and ITC there. Now, is Z purely on account of the recent correction, or Z is still a play on digitization? And what about ITC? ITC is fairly priced, and valuations are looking slightly rich there as well.
In case of Z, the reason why we like the stock is of its long-term structural story. Digitalization is clearly playing a part in that, but we have also been tracking the TRPs and the ratings, which have been moving up, which goes to show the content improvisation for the channel, and that should reflect in the ad revenue growth, etc., going forward as well. Also, we are expecting some sort of reduction in the losses in the sports initiatives. So all these 3-4 factors combined, we look at Z as one of our preferred longer term bet. The other question that you asked was pertaining to ITC. Sorry, ITC. Yes, the valuations have been moving up, but the reason why we like that story is it is one of the most stable earnings growth story in India. The company has such a dominant position in its core businesses that it has the capability to withstand any shocks, and its pricing power has helped it maintain a steady pace of earnings growth. And the other near-term trigger that we're looking at is its FMCG business, which is close to turning around, and that business should start contributing profits possibly from the next year, definitely the year after that, and which can drive up the valuations for that segment of the business, which is the reason why we like ITC.
Right, Mahesh, just going through your model portfolio, I mean, why would you remove TCS and Cipla? Do you think these stocks are looking toppish now?
Yeah, so we have been holding an overall cautious view on the IT sector for some time, and we have been proved right on that view. In case of TCS, the company has clearly executed well, and probably better than some of its peers, but the valuation gap has expanded quite a bit. So the reduction in the weight that we've done for TCS was just in line with our view of being cautious on the sector as a whole. Specific in case of Cipla, once again, the pharmaceutical sector, is facing some sort of uncertainties pertaining to the pricing policy of the government, and the reduction in some of the pharma names is also in line with the fact that we are incrementally more positive on the market outlook, and in that context, we are just taking some of the weights of the defensive stocks and the defensive sectors.
Mahesh, final question. Since you're bullish on the markets, how soon do you think Indian markets could retest the previous high or go past the previous all-time high?
Yeah, we definitely hold a constructive view on the markets as a whole, and as I said, over the next 12 months, we are looking at market performance of anywhere close to 10 to 15%, and given the markets where they are today, yeah, I mean additional 10 or 15% will take it to a new high. So having said that, one of the primary requirements for that to happen is the continuation of the current easy global liquidity conditions, because that has been one of the important factors in driving the Indian markets up the way they have this year. We have seen about $18 billion of FI inflow this year. We need to see some similar momentum to continue on the FI flows for the markets to keep on moving up, which we are quite hopeful about.